Good morning. Welcome to the first quarter 2018 inflation report press briefing. Our speakers for today's session are Deputy Governor Diwa C. Guinigundo of the BSP's Monetary Stability Sector, Senior Director Zeno Abenoja of our Department of Economic Research, and Deputy Director Dennis D. Lapid, also of our Department of Economic Research. We now turn you over to Deputy Governor Diwa Guinigundo for his opening remarks.
Good morning. Welcome to the press conference on the BSP's inflation report for the first quarter of 2018. It's always good to have music. Today, we wish to discuss with you the developments and the analysis that underpin the BSP's monetary policy decisions during the first quarter of the year. Our objective is to enable market participants, analysts in particular, and the general public to better understand the underlying developments as well. It is always useful to begin with the global economic environment. The overall prospects for global output growth have improved further, seen out by brisk economic activity and firmer growth prospects for both advanced and emerging economies. In particular, U.S. economic activity has further gained traction, and the unwinding of accommodative policy in the U.S. and other advanced economies is seen to realign capital flows away from emerging markets, including the Philippines. Meanwhile, global inflation continues to be influenced by movements in international crude oil prices, which rose significantly from the previous quarter as a result of production cuts by major producers, both OPEC and non-OPEC members. Nevertheless, we observe that higher U.S. experts still see global oil supply outstripping demand in 2018 and 2019. Non-compliance with the agreement to scale back oil output could further moderate price surges. Now, in the Philippines, we've started to feel the weight of supply-side price pressures. Headline inflation for the first quarter of 2018, using the new 2012-based Consumer Price Index series, rose to 3.8%, but remained within the national government's target range of 2 to 4% for the year. Likewise, core inflation increased using the 2006-based CPI series. The PSA has yet to produce the 2012-based core inflation series. Inflation pressures for the first quarter of 2018 were attributed to higher price increases in selected food commodities, as well as alcoholic beverages and tobacco products. Moreover, inflation expectations of private sector economists for March 2018 showed that mean inflation forecasts for 2018 and 2019 increased relative to the results in December 2017. Analysts attributed the upside risk in 2018 to 1, higher global oil prices, 2, the implementation of the tax reform, and 3, U.S. monetary policy tightening. Moreover, domestic output expansion is further reinforced by robust household and government spending as well as investments, with recent high-frequency demand indicators pointing to further expansion in the near term. Now, meanwhile, the Philippine banking system has remained broadly stable, with bank balance sheets showing sustained growth in lending and deposits, even as asset quality indicators remain healthy and capital adequacy ratios well above international standards. Domestic liquidity has been supported by continued demand for credit. At the same time, financial markets were lifted by positive investor sentiment driven by factors such as the strong fourth quarter 2017 GDP and the timely implementation of the tax reform program. Nevertheless, the ongoing tightening of U.S. monetary policy, trade tensions between the U.S. and China, as well as geopolitical tensions also dampened the view on peso-denominated assets as reflected in the depreciation of the peso and the increase in spreads on the country's sovereign debt. Now, these developments formed the backdrop for the BSP's policy decisions for the first 2008. During its monetary policy meetings in February and March, the Monetary Board decided to maintain the BSP's key policy interest rate at 3%. These decisions were anchored on the Monetary Board outturns were elevated in early 2018. The latest baseline forecast, again using the 2012 base CPI data, showed inflation remaining within the inflation target in 2018 and moderating further in 2019. At the same time, on February 15, the BSP announced the reduction in the reserve requirement ratio by 1 percentage point effective March 2 as part of operational adjustments to achieve a more market-friendly implementation of monetary policy. It is important to emphasize that the liquidity released by the reduction in the reserve requirement ratio was meant to address the virtual tax on financial intermediation, while the BSP's new TDF facilities, term deposit facility, have mopped up the increment in domestic liquidity. We expect that this move will remain policy neutral. We also need to take the recent climb in domestic inflation derives largely from supply-side factors which are expected to be transitory and therefore non-persistent. We welcome trade as it left the halls of Congress to deliver most of the resources for building and enhancing the state of infrastructure in the Philippines to ensure the sustained expansion of the country's productive capacity. Short-term inflation pressure is one of the costs of this long-term goal of higher and more inclusive economic growth. Thus, the potential inflationary impact was fully known and disclosed to the market at less than 1 percentage point. Again, we clarify that this is not expected to persist, and indeed, by the third or fourth quarter of 2018, inflation is projected to stabilize through 2019, dropping to around 3% by then. This is what is happening, and this is what we expect to happen down the road. Without this perspective, the market's inflation expectations will tend to deviate from the BSP's forecast and target of 2 to 4%. This is something that needs strong underscoring. On the issue of financial stability with a steady policy rate of 3%, the Monetary Board is cognizant of both macro and micro-prudential measures in place. RR, even after the initial reduction of 100 basis points, remains elevated to ensure appropriate levels of domestic liquidity. We have binding constraints on real estate exposure of banks, loans to officers and stockholders, single borrowers. We have prescribed high leverage. We have required banks to strengthen the risk management system and robustness against cyber attacks. They also conduct regular stress testing, particularly on their exposure to real estate. Prudential measures are more appropriate to deal with sector-specific risks and vulnerabilities. The markets have also raised concerns about the continued weakness of the peso. We have clarified, and we will clarify again today, that the exchange rate continues to be driven by fundamentals and high demand for foreign exchange to fuel imports, mostly of capital goods, raw materials, and intermediate products, outer investments for external debt payment and prepayments. In 2017 alone, prepayments by both the private sector and the government amounted to $4 billion. That's an extra demand, higher demand for foreign exchange, and therefore, the depreciation of the peso is something that one should expect. It may be true that because of monetary policy normalization in advanced economies, capital outflows would be a consequence. But our monitoring of foreign investment, particularly foreign portfolio investment for the first quarter of 2018 indicates a net inflow of more than $700 million. In March alone, net inflows amounted to $1.1 billion. So let me sum up by saying that present monetary policy settings remain appropriate given the prevailing outlook for inflation and economic activity. Notwithstanding ongoing price pressures, the outlook for inflation remains in line with the target range over the policy horizon. Financial stability is well established. However, the balance of risk to the inflation outlook remains tilted towards the upside. Accordingly, the BSP will maintain its vigilance in setting the stance of monetary policy going forward, particularly against any signs of second-run effects and inflation becoming broader based to ensure that the monetary policy stance continues to support the BSP's price stability objectives. We have no second thoughts in reconsidering the current stance of monetary policy should second-run effects become more apparent, or should inflation expectations face the likelihood of being disanchored, it only to send strong signal that BSP fully recognizes the configuration of risks and the likelihood of those risks happening. In a moment, we will provide you with a more detailed discussion of the factors behind the Monetary Board's recent decisions and its assessment of price and output conditions. Also, we will have a brief discussion of the results of the BSP's latest quarterly loan officer survey, and we look forward to your questions and perhaps comments, observations. All of these are warmly welcome at the end of these two presentations. Thank you very much and good morning.
Thank you, DG. We'll go to the first presentation for the morning, which will present the highlights of the latest inflation report. This will be given by Senior Director Abenoja.
Thank you, Dennis. Again, good morning, everyone, and thank you for attending this morning's press briefing on the inflation report for the first quarter of 2018. This is the 66th inflation report that the BSP has published since adopting or shifting to inflation targeting back in 2002. For this morning, I will be helping you go through some of the key parts of the first quarter 2018 inflation report. The first part, we will look at the recent developments covering the inflation dynamics, both the configuration from the demand as well as supply conditions in the economy back in the first quarter of this year. And then we will briefly look at financial market developments as well as external trends before concluding the recent developments portion with some review of the policy actions that were done by different central banks during in early 2018. And then we will conclude the briefing with discussion of the inflation outlook and its implication for monetary policy. So before I discuss some of these details, let me just highlight the key message contained in the first quarter 2018 inflation report. During the quarter, the BSP took careful assessment of the recent developments in the economy as well as reviewed its assessment of the economic outlook, including the inflation outlook. And the sum of the new information that was available then supports the maintenance of policy. Headline inflation projections are now higher, And this is due in part to supply-side factors, which are generally transitory in nature. But overall, the projections show that inflation is seen to remain within target over the policy horizon. Meanwhile, the balance of risk surrounding this inflation outlook is still weighted to the upside. Alongside the increase in actual inflation, we observe that inflation expectations continue to be on the rise. However, they remain anchored to target, including if you look at the 2019 inflation expectations, which are broadly in line with the projections of the BSP. Even as inflation has been increasing gradually as anticipated, we have also observed that looking at measures of economic activity back in 2017, as well as more recent or high-frequency indicators of economic activities in early 2018, domestic growth momentum continued to be intact. Moreover, if you look at liquidity and credit conditions, they continue to be supportive of the assessment of appropriate monetary policy setting during the first quarter of 2018. Finally, the global economic activity was observed to continue to strengthen. However, there are some downside risks that remain and we should be watchful of. It should be noted that during the quarter, the BSP also emphasized that it remains vigilant, and at the same time, it stands firm in its intent to take immediate and appropriate measures as necessary to ensure that the monetary policy stance continues to support the BSP's main mandate of price stability. So now let me go to some of the details that were taken into account by the BSP when it assessed the stance of monetary policy during the first quarter. First, we look at inflation trends. During the first quarter, the inflation rate averaged 3.8%. This is still within the government's target range of 2 to 4% for the year, although it has been gradually creeping higher during the first quarter. And this particular inflation rate refers to the 2012-based CPI series. So just for recall, the Philippine Statistical Authority announced back in February that it will be releasing the CPI numbers, the inflation numbers, based on a new CPI series. This review of the CPI series is done independently by the Philippine Statistical Authority. It is being done on a regular basis, and in fact, it is something that they have initiated a few years ago. And the results of that review is now being announced to the public starting last March of 2018. So in the first quarter, based on this new CPI series, inflation averaged 3.8%. It's higher than the fourth quarter 2017 average of 3%. And the drivers are mainly higher food prices, owing to some tightness in domestic supply. Lingering effects of weather disturbances affected vegetables and fruit prices. There was also the end of harvest season for the rice sector, and there was some spillover effects of the fishing ban started late in 2017, all affecting food prices. At the same time, we also observe some impact in the imposition of excise tax, higher excise tax on selected sweetened beverage. Aside from food prices, the prices for non-alcoholic and alcoholic beverages and tobacco also rose as a result of changes in the excise legislation. This portion of the inflation has remained generally steady and in fact eased a little bit during the first quarter of 2018. And this is despite the upward adjustment in gasoline and diesel prices. There was a decline in LPG prices and some other non-food inflation during the quarter that led to a steady contribution of non-food inflation to headline inflation. Equally important when assessing the stance of monetary policy is to look at the underlying inflation. This complements our analysis of what's happening to headline inflation. And we show here the various measures that we use to assess the underlying inflation, in particular the official core inflation that is being derived or computed by the Philippine Statistical Association. Right now, they still compute the core inflation based on the old CPI. And what we see here is an uptick in core inflation measures, not only the core inflation, but also the alternative measures that we compute internally within the BSP. We show here a recent, something that we have introduced just a few inflation reports ago, what is called a principal component analysis derived core inflation. That is the green line in the chart, and that has also shown an uptick in inflation expectation, but not as steep as the other measures of core inflation. We make note that the other measures of core inflation refers to an exclusion type of method, but the PCA looks at the entire distribution of inflation across the different items, and it does not exclude any item in the CPI when it tries to derive the underlying trend of prices. We also analyze what's happening to the components of the CPI in terms of those items that are above the inflation target, particularly those with inflation above 4%. And we have observed that the number of items with inflation above 4% has increased during the first quarter of 2018. And now we refer to back to the 2012 CPI series. However, the weight of those items with inflation has actually declined and reached 22.3% of the total CPI basket. So it still constitutes a minority of the entire CPI basket if we compare it to those that are within the target as well as those that are below the target. Now, we also look at inflation expectations because inflation targeting is primarily a form the BSP conducts, as well as those that are done by independent institutions. They show that inflation expectations have been rising since late last year and early in 2018. For 2018, the inflation expectations is now 4.4% using the 2006 CPI basket because the market is still getting used to the new series. So most of the forecasts are being done using the old CPI series. But for 2019 and 2020, looking at the results of the BSP survey, they are within target and has hovered at around 3.7, 3.8% over that horizon, 2019 and 2020. And this is broadly consistent with what is also observed in the other surveys, particularly, for example, those that are being done by the Asia Pacific Consensus Survey for 2018 expectations of 3.9% for 2018 and for 2019, 3.6%. So overall, if you look at the inflation scenario back in the first quarter of 2017, it has been rising. Actual inflation has been rising as expected, as anticipated since last year. There was an increase in core inflation, but if you look at the details, most of this is being driven by supply side factors that can be considered or that could be expected to be transitory in nature. Inflation expectations have also adjusted in line with the increase in actual inflation, and they have been increasing, particularly for 2018. But for 2019, inflation expectations continue to be within within the target. Now, even as inflation has gradually increased, domestic growth continues to be solid. If you look at the national income accounts, the latest available data is for 2017. For the fourth quarter of 2017, inflation has averaged, GDP reached a growth rate of 6.5%. And this brings us, if you look at over the medium term, for the past 5 years, an average growth rate for the Philippine economy of about 6.6% growth since the first quarter of 2013. That 6.6% is higher than the long-term average growth rate of about 5.2% if we look at the GDP performance since 1999 until 2017. And in recent quarters, what has been driving economic activity has been the consistent contribution of household consumption as well as government consumption spending. Investments also continue to be an important contributor. In 2017, that net exports have turned positive, slight positive in terms of contribution, except perhaps in the fourth quarter of 2017. So overall, we think that domestic growth fundamentals continue to be intact. And that is supported by more recent data. If you look at 2018 information, data that could provide guidance on what is happening in terms of economic activity, the manufacturing sector continued to grow year on year. The Purchasing Managers Index continued to be above the 50% threshold level, which means that different industries continue to be poised for expansion over the near term. For vehicle sales, there was a rapid increase in vehicle sales late in 2017, but for early 2018, that has been on average mostly flat, given that there were some adjustments in spending behavior during the first quarter of 2018. So overall, the uptick in inflation has been accompanied by maintenance of robust economic activity during the early months of 2018. Now we look at some of the supply conditions that have affected price trends during the quarter. And two of these supply factors are the oil as well as the rice sectors. So looking at the oil industry, we have observed that in the external oil market, the buy crude oil prices continued to increase during the first quarter of 2018, increasing by more than 7% compared to the last quarter of 2017. And this could be traced mainly to declining global oil inventories, some geopolitical risks, and unplanned supply outages. But if you look at the inventory for oil domestically, we can see that domestic oil supply remains adequate with the finished products inventory above the required minimum level. So the required minimum level is about 7 to 15 days worth of consumption. And during the first quarter, this was the inventory for finished product on average was more than 20 days. Now, going to the rice sector, the rice inventory for end March, as of end March 2018, is expected to last for about 52 days. And most of this stock in rice are held by the private sector, particularly the household and the commercial sector. For the NFA, the supply or the inventory has declined, but we continue to see that there is a lot of inventory being held by the rest of the private sector, particularly the commercial and the household sector. There are some increases in supply coming from the arrival of importations. In particular, about 66% of the expected rice importation under the 2017 MAV has arrived as of end February, and that has complemented the production, the local production of rice. Moving forward, we also note that the NFA has already started or initiated the importation of more rice to arrive in May, in June, under a G2G program. And that importation will also complement uh, the harvest that is expected during the summer months, as well as the arrival of more imports under the second phase of the 2017 MAV, and that should arrive during the onset of the lean season. So overall, if you look at the supply conditions, two commodities that affect domestic prices, oil and rice, we continue to see adequate supply for both commodities over the near term. And there are some actions being undertaken to ensure that there is adequate supply for both key commodities. Now, turning over to monetary and credit conditions, we continue to see strong credit demand and ample liquidity conditions, and this provides support to economic activity over the near term. The has been hovering at around 13, 14% growth in the past few quarters. Last February, it reached a growth rate of 13.5%. Bank lending continues to be robust, growing by 19.5% as of February 2018. And most of this credit is going to production sector, supportive of economic activity moving forward. And even as we see a robust credit growth, the overall credit standards that are being adopted by the banking sector remains broadly unchanged. Overall, if you look at the trend in the credit standards, there's been an overall tightening after the great financial crisis in 07 and 08. And since then, credit standards have been broadly steady with some changes, but broadly it has been steady. And later we will standards, but just to provide a quick preview, it will show that the credit standards, whether we look at loans to enterprises, households, commercial sectors, or housing, all will show that using the modal approach, credit standards have been broadly steady. Shifting to developments in the financial market, developments during the quarter reflect the uncertainty coming from the external sector. For the exchange rate, the peso-dollar rate, we have seen depreciation pressures on the peso, and this has been partly due to the talks about the normalization of the U.S. Fed policy rate. But at the same time, there are some fundamental factors driving the exchange rate, and these factors, as mentioned by the Deputy Governor, are linked to positive developments in terms of a growing economy. An expanding economy continues to invest, and that will entail more imports, that will entail diversification of their exposures, and some of it may be invested abroad. And as corporate sector continue to earn more, gain profitability in an expanding economy, they have opportunities to also invest in other markets, as well as prepay some of their foreign obligations. And all of this were translated to greater foreign exchange demand and were reflected in the foreign exchange market. In terms of the equities market, during that quarter, we have seen an improvement or a rise in the stock exchange rate, stock exchange index, which rose by about 2.6% quarter on quarter. But developments, recent developments in March and April saw a downturn in the stock exchange index. Meanwhile, in terms of the debt spreads, again reflecting some uncertainty on the external front, there was some slight uptick in the debt spreads, but they continue to be generally low. Now, still on the external environment, we look at the global growth prospects, and we see that they have strengthened. In fact, if you look at the recently released IMF World Economic Outlook, the estimate for 2018 is that global growth will accelerate to 3.9% from a growth of 3.8% in 2017. And these projections reflect the expected strong economic growth momentum, favorable market sentiment, some good financial conditions, and some policies in advanced economies, including expansionary fiscal policy in the US. However, the same report by the IMF also flagged several downside risks for the global growth over the near to medium term. And those downside risks constitute, for example, possible for buildup of financial vulnerabilities and possible rapid tightening of global financial conditions. The talk about inward-looking policies could also affect international trade and could have adverse impact on global economic activity. But overall, we think that over the near term, the global growth prospects remain robust. There's been some easing in global manufacturing activity, but they remain on an expansionary mode. And this can be seen by the purchasing managers indices in different jurisdictions covering advanced economies as well as big emerging markets. If you look at central bank policy actions during the first quarter, for most of the central banks, policy settings were unchanged. However, three central banks, namely the Bank of Canada, Bank Negara Malaysia, and the US Fed, decided to raise their respective policy settings as of March 2018 on the back of data supporting good prospects for growth as well as gradually increasing inflation over the near term. So those were the major considerations that were taken into account by the BSP when it reviewed the monetary policy stance during the quarter. And those assessments were inputted in terms of formulating the inflation outlook. So how does the BSP see the inflation path over the policy horizon? In terms of the inflation outlook, the BSP expects inflation to settle close to the high end of the target range in 2018. And we are now referring to the inflation as measured by the new CPI series. But for 2019, we think it will settle around the midpoint of the target range at around 3%. Now, what are the risks surrounding this inflation outlook? The upside factors continue to dominate the upside risk, and this could come from the possibility of additional wage adjustments as well as potential increase in transport fare hikes. Let me just clarify that in the baseline outlook of the BSP, a wage adjustment has already been taken into account. And what is being flagged here is the possibility of additional wage adjustment. Other factors that could affect inflation on the upside could be the pending petitions for electricity rate adjustments, as well as the possibility of faster than expected monetary policy normalization in the US. The downside factors could be the possible slowing down of the global growth, as well as the replacement of quantitative restrictions with tariffs when we talk about the rice trade regime. In assessing the upside factors, we should also mention that there were a lot of discussion on the mitigation measures that we see. While there are some potential second-round effects, that could come from the initial increase in inflation during the first quarter, um, there are mitigating programs that are already being implemented by the government and even by the private sector. For example, in terms of second round effects coming from higher minimum wage adjustments, we have the unconditional cash transfers, which have been started back in March of this year and will continue to be implemented for the rest of the year. And this should temper the demand for higher wage adjustments from the labor sector. In terms of the public utility transport sector, the transport fare hike could be mitigated by a subsidy under the Pantawid Pasada program. And this is something that is being initiated, being looked into right now by the national government. In terms of inflation expectations, the Congress continued to intensify its efforts to pass a bill reforming the trade regime of the rice industry. And there's also a close monitoring of prices that are being done, for example, by the DTI, the Department of Agriculture, and even the Department of Energy. All of these efforts should help mitigate the occurrence of second round effects. In fact, the private sector has also volunteered. For example, we've seen rice traders delivering rice to urban centers at a lower price than what was initially observed during the early months of the year. We have also observed that that private companies, oil companies, have initiated a memorandum of understanding with the Department of Energy to provide discounts to the jeepney sector so as to alleviate the impact of increase in excise taxes on the income of the jeepney drivers. Now, taking into account all these developments as well as the different risk factors, the inflation path that we now reflect in our fund chart is slightly higher for both 2018 and 2019. And we could emphasize that particularly for 2019, it remains well within the target over that year. Now, how does the inflation outlook affect the stance of BSP monetary policy? During the quarter, the BSP decided to keep its policy rate unchanged. In particular, it maintained the RRP rate at 3.0%. However, at the same time, the BSP also initiated an operational adjustment, and this is in terms of reducing the reserve requirement ratio by 1 percentage point from 20% to 19% for key types of deposits, and this was made effective last March, 2nd of March, 2018. The BSP deemed that the monetary policy setting at that time remained appropriate, primarily as the baseline inflation projections show within target inflation over 2018 and 2019. Inflation has increased in the first quarter, but remained in line with the BSP's baseline forecast scenario. In fact, if you look at inflation expectations back then, they are higher indeed for 2018, but they also revert to around the middle of the target for the year 2019. At the same time, domestic activity continued to be firm on the back of robust domestic demand, strong growth in liquidity, as well as credit, as well as the sustained recovery of the global economy. Nevertheless, the BSP continued to see upside risk in the inflation outlook. And that is why the BSP will continue to be watchful at supply side factors, how it will evolve over the near term, and the BSP will also continue to monitor inflation expectations. Moving forward, the BSP stands firm in its intent to make immediate and appropriate measures as needed to ensure that the monetary policy stance continues to support the BSP's main mandate of price stability objective. So that concludes the briefing on the key messages, the key content of the first quarter 2018 inflation report. Thank you for your attention.
Thank you, Director Abenoja. So we move on now to the second presentation, which is on the latest round of the Senior Loan Officer Survey, and this is for the first quarter of 2018. So we'll follow the usual outline. For those of you who are not familiar with the survey, let me give a brief overview, and then we'll move on to the results themselves, and then we'll do a recap at the end. So we've been doing this survey since 2009. This is mainly a tool for the BSP to understand better the overall thinking or the attitudes among the banks in terms of their lending to their clients. So every quarter we send out the questionnaire to senior loan officers of the commercial banks, and at this point we're surveying the commercial banks. The questionnaire is in two parts. We ask about loans to enterprises and also loans to households. We ask them about their general credit standards, as well as what sort of factors they're seeing that are affecting they think are affecting the supply of loans, the supply and demand for loans. Starting in 2011, we've also added this brief section on commercial real estate loans, and you'll see the results later on. So the survey questions themselves ask about bank credit standards, and by credit standards we mean things like loan collateral requirements, loan margins, and so on. We ask them about what they think is happening to loan demand, and then and also ask them to identify the different factors that are affecting supply and demand. Then when we present the results, we use two main approaches. One is we show what the majority of the respondents gave us an answer, whether they tightened or loosened or kept their standards unchanged. So that's the modal approach. The second way that we present the results is the diffusion index, so which is the proportion that said they tightened minus the proportion that said they loosened. So a positive index is a net means a net tightening. A negative index means a net loosening or net easing. In terms of the survey response, right now there's 43 universal and commercial banks. So of this number, 35 are in our survey, and on average, we get responses from 29 banks, and for this latest round, we received answers from 30 banks. So that's a good response rate, and we're extremely grateful to the banks for their continued support of the survey. Later on, we hope to expand also the universe or the survey base for this for the SLOS to include some of the smaller banks as well. So moving on to the results in terms of the change in credit standards. So this slide shows the modal approach, or what the majority reported. And as you can see, for the four loan categories, loans to enterprises, households, commercial real estate, and housing loans, as shown by the blue bars, 4 sets of blue bars, the majority are still reporting unchanged overall credit standards for the first quarter. And the next slide shows the behavior of the modal response over time. As you can see, it's coming from a low base back in 2009, and that's largely an effect of the global financial crisis where, as earlier mentioned, lending attitudes have tightened somewhat. So in the recent period, the majority response for the different loan categories have consistently pointed towards unchanged. credit standards. In the next slide, we show you the diffusion index approach for the current quarter. So for the current quarter, we saw unchanged credit standards for loans to enterprises. On the other hand, there's a net tightening of credit standards for the loans to households, commercial real estate, and also for housing loans. In the case of for loans to businesses, the unchanged standards was attributed to a bank's steady outlook for the economy as a whole, and also their outlook for major key industries that they're lending to, as well as banks' unchanged tolerance for risk and also the stable profile for borrowers. In terms of the specific credit standards, the diffusion index-based results showed unchanged maturities of loans to enterprises. There was a narrowing of net narrowing of loan margins, a net increase in credit sizes, a net easing of collateral requirements, and also a net tightening of standards in terms of loan covenants, and also increased use of interest rate floors. In the case of the loans to household, where we saw net tightening, also for commercial real estate and housing loans, this was attributed mainly to reduced tolerance for risk among the banks, as well as perceptions of stricter financial system regulations, and as well as tighter credit standards for commercial real estate loans. In the next slide, we look at the outlook for the next quarter. So the outlook for the second quarter, based on the latest survey, shows a net easing of credit standards for loans to enterprises, unchanged credit standards for household loans, and that includes also the housing loans, and net tightening of standards for commercial real estate loans. So the respondents, according to the survey, the respondents expect credit standards for business loans to ease over the next quarter, largely because of banks' more favorable economic outlook and their expectations of an improvement in the liquidity of their portfolio. For the loans to households, as well as for the housing, range credit standards was due to unchanged standards, unchanged tolerance for risk, stable economic outlook, and also unchanged borrower profiles. In the case of the commercial real estate loans, the respondents expect the credit standards to tighten over the next quarter, and this is because of perception of stricter financial system regulation. In the next slide, we show the behavior of the diffusion index over time. As you can see from the upper part of the slide, over time, the loans to enterprises and households have been shown a general decline in the diffusion index. So it suggests a more broad easing of standards. For the commercial real estate loan, there appears to have been a net tightening, particularly in the recent period. In the case of the housing loans, it's less clear, although the overall indices that we've been seeing have been generally positive as well. In the next slide, we look at now the change in loan demand. And again, this is the modal approach. So as you can see from the blue bars, well, the banks are seeing steady overall loan demand. And that's what the majority are reporting. And that's true for all four loan categories: businesses, households, commercial real estate, and also housing loans. In the next slide, we show the overall trend, the time series trend for the different loan categories. So the modal response has been quite steady in the case of loans to enterprises and households. That's I think that's the red and blue bars. For housing loans, stronger or an increasing proportion of banks reporting unchanged loan demand. In the next slide, we look at the diffusion index approach for the question on loan demand. And here, in the current quarter, seeing a net increase, or we continue to see a net increase in loan demand across the four types of loans. So there was a net increase in loan demand at firms, and this was largely attributed by the banks to higher working capital requirements among the businesses, as well as attractive financing terms being offered by the banks. On the other hand, the respondent banks attributed the net increase in demand for household loans to low interest rates, more attractive financing terms being offered by the banks, and also increased consumer spending. The next slide highlights the outlook for the next quarter, for the second quarter. And here, as you can see, we're also seeing a net, or the banks are also expecting a net increase in loan demand across the four different types. According to the respondent banks, they're expecting higher investments in plant and equipment, increased working capital needs, and also they're seeing increased loan demand because of low interest rates. So those were the key factors that they're seeing as driving the increase in loan demand among the businesses. In the case of the household loan demand, this is attributed by the respondent banks to more attractive financing terms being offered to household borrowers, and also low interest rates, along with overall strong consumer spending. In the next slide, we show you the behavior of the loan demand diffusion index over time. And as you can see, loan demand has been quite strong. So we're generally seeing increased loan demand over time. So to sum up, the results of the first quarter loan officer survey indicates that on the whole, most of the respondent banks have maintained their lending standards for loans to both enterprises and household in the first quarter. And this is, as earlier mentioned, this is the 36th consecutive quarter since 2009 that most banks have reported broadly unchanged credit standards. In the case of the diffusion index approach, we saw unchanged credit standards for loans to enterprises. There was a net tightening in credit standards for household loans. Meanwhile, credit standards for commercial real estate and also housing loans also showed a net tightening based on the diffusion index data. Nonetheless, the survey results also consistently pointed to robust loan demand from both businesses and household during the first quarter. And so that's the second presentation on the senior loan officer survey. So I think we'll open up the floor now to your questions.